Welcome to Puerto Rico tax incentives. What is real, what is risky, and what practitioners need to know. I'm Philip Aaron, chair of the BHBA tax section, and also principal at Hoffman Sorkin Tosha Perez. And Hoffman Sorkin Tosha Perez is sponsoring the tax section. Hoffman Sorkin is an advantage. Hoffman Sorkin Tosha Perez advantage is experience, an eye for innovation, and a genuine dedication to clients, their families, and their business. In addition to their national practice in civil and criminal tax controversies and related litigation in federal and state courts, the firm is also active and successful in handling other non-tax white-collar investigation and prosecution. I'm delighted to introduce our speakers today who join me for this presentation, Jorge Quilan and Jorge Oben Cuadros. Jorge Quilan, CPA, and serves as Puerto Rico Tax Director of CFO Associates, LLC, where he works with business owners, multinational entities, and high net worth individuals on Puerto Rico and U.S. tax compliance, including matters related to Puerto Rico's incentive tax regime under Act 20, 22, and 60. With more than a decade of experience in tax advisory, Jorge has navigated the intersection of U.S. federal tax law and Puerto Rico's unique regulatory environment. Before joining CFO Associates, he served as international tax manager at the Strategic Group PR and as tax advisor at BDO Puerto Rico USVI. Jorge holds a BBA in accounting from the University of Puerto Rico, Rio Piedras, a U.S. international tax certificate from the AICPA, and a postgraduate diploma in transfer pricing from Middlesex University. Jorge Oben Cuadros is partner at Procopio, who advises multinational corporations, defense contractors, investment funds, high net worth individuals, and family offices, particularly from Latin America, Puerto Rico, and Europe, on U.S. and international tax and trade matters, with a focus on inbound structuring, cross-border planning, tariff exposure, and tax and trade litigation. Prior to joining Procopio, he serves in the U.S. Internal Revenue Service Office of Associate Chief Counsel International, where we helped draft the GILTI regulations under Section 951 Cap A, and later as the IRS detailee to the U.S. House Ways and Means Committee, contributing to international tax legislation, Puerto Rico, and territory matters, and the energy provisions of the Inflation Reduction Act of 2022. Jorge has secured significant results for clients in IRS controversy matters, including penalty abatement and refunds exceeding $850,000 through escalation to the IRS Taxpayer Advocate Service. And now let's get started. So we start with the next slide. Can you start with the risk framework and the history of the Puerto Rico incentives?
Thank you so much, Philip, and thanks you to the Beverly Hills Bar Association for inviting us for this event today. So many of you have heard about Puerto Rico, maybe because you're in California, it could be because of the surfing. Some of you may have also heard about it because of the tax incentives it offers. But these incentives are not necessarily new. As a baseline matter, you can think that, I assume this audience is attorneys, accountants, CPAs, tax advisors. We all know that if the U.S. subjects a U.S. person or a resident to tax if they perform services in the United States. So you have a barista making coffees down in Pacific Beach. They will pay federal taxes. I'm not advising in California, but they would potentially pay California taxes, federal taxes. If that same person provided services as a barista in Italy, because the person is a U.S. citizen, the U.S. would also tax it. But what happens when that person likes to serve and opens up a shop in Rincon on the west side of Puerto Rico that looks like that, like the West Coast in California? The answer is not that clear. And the answer is not that clear because Puerto Rico is this unique situation. It's a unique political territory. It's a non-incorporated territory of the United States, and the facts matter. By way of background, Puerto Rico has been coming up more and more in the individual perspective since around 2012 when the island enacted some tax incentives. But why does it matter and why are we having this discussion today? Well, as we'll talk about in a few minutes, Puerto Rico has used a recipe that they had done for over 60, 70 years for big companies. And since 2012, they enacted and extended that to individuals. So now folks who move to Puerto Rico, individuals could potentially receive significant tax benefits. So what happens and what is the context that we're dealing with? Again, if you're a US citizen, US resident, the US will potentially subject you to their tax regime. In addition, you could have California taxes, as many of the folks in our audience may be advising clients who are residing in California. But as Puerto Rico being treated as a foreign territory, as a foreign jurisdiction for US international tax purposes, the rules change. So the US person will still be subject to US federal income tax. The island will impose its own tax rules, local rules, which are completely separate and distinct from the US federal rules. And you have a complicated situation in which both overlap and both come together. And if they're not carefully assembled, if you're not carefully attacked or approached, you end up in a situation in which you have multiple taxes coming into effect and not the outcome that we want. But what has happened in the last few years? For about 13 years, Puerto Rico has enacted these benefits that Jorge will get into in more detail. But effectively, if you move to Puerto Rico, you really move, you establish residency. Again, we're going to get into the details. This is just an overview. You can get outside of the federal income tax fisc as an individual and not be subject to federal income tax. Again, the caveat for California, because it is a very known taxing authority, you have to do a separate analysis for California residency that we're talking to a little bit, and Philip is going to chime in details. But you're subject to federal income tax as an individual, but you're excluded because you're a bona fide resident of Puerto Rico. And then you turn over to Jorge to tell you how Puerto Rico is going to tax that. Well, Puerto Rico is going to impose its own revenue code, which actually mirrors the 1954 code, and it's been subject to multiple changes since then, but it's based out of that code. So many of the principles are similar. And Puerto Rico will generally tax you under their own rules. However, since 2012, the island has extended these incentives. Basically, can say, like, if you move to Puerto Rico and you comply with all these requirements, we'll give you a preferential tax rate. So what has to happen for this to come together? Well, you have to break residency in the United States. You have to meet the requirements in Puerto Rico. You have to look at your current stateside situation, whether it's California, whether it's Florida, whether it's Texas. Some of these jurisdictions are more complicated than others. And in California in particular, it's very hard to break residency. So it takes some time to plan and get into it with the proper precautions. So you might get calls from clients say, hey, I went to Puerto Rico for a trip and I heard about these incentives and I think I want to move down there. I'm actually looking for an investment banker to sell my business. And, we might get an offer by Q4. Can I just move down and exclude all the gain from federal income taxes and or California federal taxes? Well, it's not that easy. You might also get a question like, hey, can I just move there for 183 days and get the benefits? No, that's also not the case. Again, you have to break residency in the United States. You potentially have to break residency in your current state if it's a state that imposes income taxes. And then you got to make sure that you meet the Puerto Rico requirements if you are going to pursue a tax decree for the tax incentives. And moving to Puerto Rico without a tax incentive is not necessarily a tax efficient situation, as the standard regular graduated tax rates in Puerto Rico are also pretty high. So thinking about Puerto Rico and what's the storyline here? So Puerto Rico has been doing tax incentives since 1947. Puerto Rico was an agricultural economy, and in the earlier years of the 50s, the US government decided to pivot Puerto Rico's economy into a more industrial economy. And since then, the US and Puerto Rico had worked in tandem to create incentives in which companies would be totally or partially exempted from US tax and Puerto Rico taxes on income generated by a select number of companies who created jobs and invested in the island. So typically the benefits were created to incentivize development locally, to foster jobs, build schools, build parks, build roads. And that was the idea behind this thing, again, that started in 1947. Through the years, and in particular in 1976, the US Congress enacted what was the Possessions Tax Credit, or Section 936, as many of you may have heard or known. It's no longer in effect, but this provision effectively gave U.S. companies a tax credit in the United States for whatever their tax liability would be with respect to their income generated in Puerto Rico. So think about the biggest pharmaceutical companies in the world, the biggest manufacturing companies in the world. They move operations to Puerto Rico. They hire 4,000 employees. They build schools. It's great for Puerto Rico. It's great for U.S. citizens who live in Puerto Rico. And it's good for the economy because the companies can produce all these goods, whether it's medicine or manufactured items at a reduced rate. And then we're building a stronger United States. With time, the pharmaceutical companies started to relocate intellectual property and using the incentives to protect taxes or get more tax efficient outcomes on intellectual property and other non assets not associated or income not associated to investment on the island or employment, which led to the tension that happened for many, many years until eventually at the end of 1995, Congress repealed Section 936 with a 10-year phase down. And why does that matter? Because that 10-year phase down, while there is no specific economic data that can prove this, could potentially have caused the bankruptcy of the island in 2012 that eventually led to this Act 2022, as we were talking about tax incentives in Puerto Rico. So Puerto Rico had been doing incentives for the longest time. Again, it was the biggest companies that were doing this, the Mercks, the Johnson & Johnsons, the Eli Lillys. And they were producing, I think there's a report that 17 of the 20 most prescribed medications in the United States were manufactured in Puerto Rico during all those years. So we're talking massive amounts of revenue. There was a lot of employment, there was a lot of investment in the island. The Band-Aid gets stripped, the island loses that employment. Many companies divest from Puerto Rico, and the island suffers from a massive brain drain of most folks many folks who are in the younger, early stages of their career. So Puerto Rico reacts, and Puerto Rico reacts by creating the Act 20 and the Act 22 acts, which basically incentivize individual investors to relocate to Puerto Rico and establish local operations that provides export services. So services to folks or other companies outside of Puerto Rico, with the idea that that's going to move the economy. There's going to be more work. There's going to be people going out and dining. There's going to be people buying properties. There's going to be people going to school, buying cars. And that's the background to where we are today. Jorge, can you talk us through what exactly Puerto Rico did?
Sure, Jorge, and thank you for the opportunity and to Beverly Hills Bar Association for having me here. So essentially, Jorge has basically laid out the context to how these incentives are available. So, first, the vehicle to get it is the decree, which there's a common misconception that you get the decree and then basically you don't have to comply with anything else. Like, getting the decree is just a step one. It is handled by an agency that is not the agency that collects the income tax in Puerto Rico, which is the Puerto Rico Treasury Department. We call it Hacienda. It's the equivalent to the Puerto Rico IRS. So the decree is the local incentive. It starts the analysis. It is handled by the Office of Incentives of the Puerto Rico Economic Development Department. And basically, it is anchored on the fact that you can meet the different federal tests related to residency. So the idea here is that even though it is based on the exclusion from Puerto Rico-sourced income provided by the U.S. Internal Revenue Code Section 933, it does not bind the IRS. It's a local filing. It's a contract actually between the individual or the company and the Puerto Rico government, and it has a specific clauses that individual or company needs to comply. So what that also means is that, and I'll explain in a little bit more detail in the next slides, it does not prevent U.S. tax. And this is something that the IRS is looking carefully because you want to make sure that anything that appreciated before moving to Puerto Rico is still taxed by the IRS. Also, any source of income item that is sourced to the U.S. mainly interest and dividends, that are being paid by US sources or payers are also taxed by the IRS. So Puerto Rico won't tax it, but you have to be careful of what is actually sourced to Puerto Rico in order to make sure that you cover the federal tax liability associated to it. So now I will get into a little bit more detail of what's actually in the decree. So here, the way I'm presenting it is that we're going to focus on the investors and the export services. I mean, Act 60 has a plethora of industries that it serves, but the ones that we're going to focus on, the ones that are attracting most of the activity right now inbound to Puerto Rico, is the investors and the export services. For investors, there is currently a regime in place until the end of the year. So it's the 0% that's been available since the enactment of Act 22 back in 2012. That one is going to sunset at the end of the year. So, but remember that it's on the appreciation after becoming a resident. Same goes with the interest and dividends. Those won't be taxed by Puerto Rico, no matter their source, but then they will be taxed by the IRS if they are US sourced. It's the same concept. Now, the way I'm dividing it in the slides is that the new regime will apply for those who apply for a decree upon January 1st, 2027. So it's the same concept with the 0% post-move capital gains, but now it will be a 4% preferential rate. Then one thing to keep in mind, and based on what we've been discussing, is that anything that will be pre-move gains will remain taxable in the US when realized. And then since Puerto Rico has a worldwide income taxation regime, these will also be taxable by Puerto Rico. You will have the ability to claim a credit for taxes paid to the US, so there's not going to be double taxation. But generally speaking, the Puerto Rico tax rates tend to be higher, so that it's not going to be a dollar by dollar credit, but good to keep in mind. Then those pre-move gains, if they are short-term gains, they're going to be taxed at ordinary rates in Puerto Rico. We're talking about 33% max rate for capital gains exceeding $60,000 approximately. And then if it's a long-term gain, it will be taxed at 15%, and it can be 24% if that long-term gain exceeds $250,000. Then eligibility, basically, it has also changed with the new regime that applies next year, because it is broadening the basis of the individuals that would be subject. But right now, the eligibility is that you must not have lived in Puerto Rico between January 17, 2006 and January 17, 2012. And again, that's for those who apply by the end of the year. And then if you apply next year, the blackout period is that you must not have lived in Puerto Rico for 6 years before your actual move to Puerto Rico. So again, it's an effort from the government to amplify the benefit or the pool of investors that would be eligible. Then as to the validity of the decree, under the current regime, they are going to sunset on December 31st, 2035. So once you get the decree, it is valid until then. And then for those who apply under the new regime next year, then it will be valid until December 31st, 2055. So as opposed to export services companies, individual investors' decrees don't have a term per se, but rather a sunset clause. And it can be extended if new legislation is enacted for it. Then as to the requirements per se, it's a 10,000 charitable contribution to a specific nonprofits. It applies upon the decree's second year, and there's a specific list of qualified nonprofits that need to be donated to. Then the annual report, and this is the most critical compliance item. I mean, like, it is typical for the government to revoke your grant if you don't actually file those annual reports. So it's very important that you file them. And the same goes with export service companies. Can you go back to the prior slide, please, Suzanne? I'm sorry. Okay, so, and then the last requirement for individual investors is buying a property in Puerto Rico. It doesn't need to be of a specific amount or type. I mean, although it has to be your primary residence. It's the use that you give to it that the government is looking for, and they give you 2 years after the decree is approved to purchase it. So now in the same slide, Chapter 3 Export Services, this one doesn't have a new regime starting next year, so it remains a 4% flat Puerto Rico income tax rate on net income from qualifying export services. There could be a 2% for 5 years if the company is a new small and medium-sized business, which essentially is a company that generates less than 2 million in gross revenues. The main requirement is that the services must be rendered for use outside Puerto Rico, so it cannot have any nexus to Puerto Rico, and it has to be consumed out of Puerto Rico. Then the way you can operate is through a Puerto Rico registered entity or an entity that is not Puerto Rico registered, but is authorized to do business in Puerto Rico. Individuals also are eligible for the export services, although it's not common to apply as an individual. Then the decree as to the term is for 15 years, and it can be extended for 15 additional years. So as opposed to the investors, it has an actual term that can be extended. As to the services that are eligible, we're talking about mainly, virtually any service, including export trade companies. As to the requirements, it's 1 employee will be mandatory, so it's generous if gross revenue exceeds 3 million. Then once again, the annual reports need to be filed by November 15. That's super important. The filing fee is lower than for investors. And that annual report is going to gather all the requirements of the decree, including the different annual Puerto Rico tax filings and requirements, because remember that this agency is only to maintain your decree, but then there's 3 additional agencies, namely the Puerto Rico municipalities, the Puerto Rico State Department, and the Puerto Rico Treasury, that is going to require annual filings as well in order for the grant to be in good standing. So there's always got to be more items to cross locally than federally in most cases. And then lastly, the accounting books need to identify the eligible service income. There are cases where there's non-eligible service income as well that needs to be identified. And again, that is a requirement that stems from the decrees. So now going to the decree compliance slide. Basically, the application is filed online through the incentives portal. And again, it's of the Office of Incentives that deals with the decrees. The filing fee is $5,005 for resident investors. It's lower for export service entities, $1,005. The fee is paid simultaneously with the filing. So if the filing goes through, it means that you paid the fee. As to the timing of the decree's issuance, it is issued within 12 to 18 months based on experience. And the decree, this is very important as well. You don't need to, not only you need to have the paper, but you actually have to formally accept it within 60 days after receipt. Otherwise, it becomes null and void. And again, it's part of the different clauses that are typical in the grants. Then likewise, in the case of investors, you have to notify the residency. You generally have a year after decree approval to make the move. And again, it's another formality that is needed for the decree to become effective. Export services companies similarly need to notify the commencement of operations because that will determine when the different tax benefits will apply for income tax purposes, gross receipts tax purposes, personal property tax purposes. Those are the main ones that are going to or need to be consistent across the board in terms of when you actually commence operations. And once again, I cannot reiterate more than filing the annual reports is critical because based on experience, that's the low-hanging fruit the government is looking for. And it's a commonality that grantees in certain years they fail to file their reports. So it is very important to keep that in mind.
Jorge, while you're talking about these points, something comes to mind that I think we typically forget when we're talking to potential clients stateside, and it's that to understand Puerto Rico, there's the Puerto Rico Treasury Department, which is the equivalent of both Treasury and the IRS. But there is this office, the Department of Economic Development and Commerce, which has been there for, again, over 50, 60, 70 years, that handles tax incentives as part of several other operations. But it's its own agency, and it works alongside the Department of Treasury, the Hacienda in Puerto Rico, but it's a different agency. And you do have to work with all these stakeholders to get everything in order, because it's not like some other jurisdictions in which you qualify for an incentive and you just file your tax return taking the benefit. These actually require proactive actions. You need to file the tax grant application. You have ongoing maintenance that you have to comply with, and at the expense of not getting the benefits. And the Puerto Rico government has recently been more proactive in revoking some of these grants if the taxpayer or grantee holder does not comply with the requirements. It is a legal binding agreement that the grantee enters into with the government, and it's contractual in nature. So any reason to terminate the contract, like for non-compliance, would be taken seriously.
Certainly, Jorge. No, again, reading the decree once you get it is critical, and you need to act upon it, because again, just having an approved and signed decree is no guarantee of being able to get the benefit. You have to formally accept it, and then on an annual basis, you have to renew it, practically speaking. So yes, that's the reality. So Jorge, I'll let you take it from here again regarding bona fide residency.
Yeah, and maybe just add a few more points on that. So the DDEC in Hacienda, to the surprise of many, including myself, is in a very good position from a technical and technology perspective. Unlike the IRS, they have really modern systems. They have live information sharing. They are doing a lot of tracking of who is applying. They are also working in tandem with the Internal Revenue Service for anyone who runs afoul of any federal tax issues stateside. So while the island is in need for additional capital and it's been struggling with through a financial crisis for a decade or so, it is running a tight ship when it comes to the DDEC and when it comes to the Puerto Rico Treasury Department. So some folks find that surprising, that everything is digital, everything is electronic. Jorge, as you mentioned, you file this electronically. It is a good system, and they have really good staff running the operations on the island. One additional point that I do want to clarify, because we jumped in part, it's my fault. So when we had in the slide that preceded this one, Act 60, it is because in 2019, the government of Puerto Rico, the Legislative Assembly, combined all these different tax incentive provisions into what's called the Tax Incentives Code. So that's why we now have Chapter 2, Chapter 3. We have, I joke about this, but it's like the Cheesecake Factory with many of incentives. You have filming incentives, which are very relevant to companies and stakeholders in LA or Los Angeles. Then you have incentives for musical performances, for expert services. You have grant for young, new entrepreneurs. And the government just combined everything into a single code that would simplify its use. Again, prior to 2012, many of these provisions and benefits were only granted to a handful of companies, the biggest, most profitable companies. And it wasn't until 2012 that this changed. And that's actually one of the reasons it's become so sensitive from an IRS perspective. Before 2012, the people who were benefiting from these incentives were big companies that presumably were hiring folks on the island that were investing on the island. In 2012, when this pivots into individual investors, the number just skyrockets. And it skyrockets with very wealthy folks who represent a lot of tax revenue for the US government. So the IRS has felt the change and the relocation of some of these individuals to the island. And it's drawn some scrutiny because although many folks are doing things correctly, there have been a number of known cases in which the IRS has found, along with the Department of Justice, cases in which the rules have not been followed, and in some cases, even intentionally. So when these events start showing up or coming up, there's been a lot of congressional oversight. There's been a lot of stakeholder oversight. There's been a lot of public protests against the situation. And then there's also folks at the IRS or the responsibility to make sure that the rules of the Internal Revenue Code are followed as they should. So that is a little bit of the background here as to why there is so much pressure into doing this right. And it works. The tax incentives of relocation, everything works if it's done correctly. And what that means is that you really meet the rules that we're going to talk about now, that you really look into the character of the income that you're generating, that you really go through the documentation and you keep everything properly documented. So what is the first area that you should all be thinking about when you're thinking about Puerto Rico? The first question you get, I will be in the island 183 days, and then I come back to my house in Laguna Beach. Doesn't work that way. The residency test under Section 937 has 3 prongs: presence, the tax home, and the closer connection. The presence test is that yes, you have to be physically present on the island for at least 183 days. And the general rules day for day, looking back, there's a proportionate rule that goes back to 1 year back, 2 years back. But effectively, you do have to go to the island. You might be surprised or maybe not, but there are some folks who have insisted that they want to apply for tax benefits, but they don't want to move to the island. It doesn't work, and it doesn't work. And it's if you even try that and you get caught, the consequences could be very, very bad. Several years ago, the USVI had this platform in which they invited folks to move to the island. And the IRS had a number of significant wins with those folks in those cases. And the main issue was that folks were not really relocated to the USVI. So after those successful litigation and cases, they have that script already drawn up. And they're using the same rules and principles that they used back then for these battles. And it's the IRS has actually gathered more information. There's more information sharing at the moment. They have more resources from a technology perspective. There's information sharing with Puerto Rico. They have a really thorough ability to gather information. So you do have to be on the island. The second prong is a tax zone. Where do you have your primary place of business? Where are you providing services? If you have an office in Puerto Rico, if you are working from home, you have to prove that you've been there. You have to prove that you don't have a tax home stateside. It means that you're really engaged in a business, and the tax home is defined as the place where you have your primary place of business. The third one is potentially the most sensitive and complicated one. It's a closer connection one. And why is it complicated? It's because there's not a single dispositive factor that will tell you whether you're a bona fide resident of Puerto Rico or you're not a bona fide resident of Puerto Rico. So the general case baseline scenario, you move to Puerto Rico, you comply with the days, you do have your tax home in Puerto Rico, but if you're married, you have children, young children, and you own a house in Malibu, your wife stays behind, your kids are still in California, and you still own that house, you're still part of the country club, you're part of the sailing club, and you only go to Puerto Rico for a couple of days, working a co-work office, that is not going to be enough. And the IRS is going to strike that down, because you really have to move, you really have to demonstrate that your closer connection is to the island. You have to sever those ties. For instance, one question that I work with quite a bit with some clients, some of them are less attached to their homes. They feel that they have their kids raised in those houses. Ideally, you would want to either sell the property or rent it, not Airbnb, not via VRBO, but send it a long-term lease that you don't have access. So if you do have access to the property, it creates a problem for your closer connection test. And again, one single factor is not going to be this positive, but you will have an issue. So what other things does the IRS look at? Recent information document requests ask for a lot of information. They ask for your calendar. They ask for travel ticket dates. When were you on the island? Show me that your flight tickets. Show me your records. Show me your credit card statements. Show me that you have signed up for a local club. Show me that you've canceled your clubs in the other where you formerly resided. Potential issues, closer connection. you were a partner in a U.S. business that is a partnership and you're providing services from Puerto Rico, you are potentially still a partner in a U.S. business. That is a problem. Big issue. Your family stays behind and you visit them every other weekend for 2 days. Establishing bona fide residency really requires that you sever your ties and you move to Puerto Rico. And the biggest tool that you can have at this stage for your own protection is to have contemporaneous documentation. Keep good records, work on memos that state when you were on the island, what you did, when you lease your agreement, when you buy your property. And that's something we've been doing for a number of clients, and it's really helpful when you get a letter from the IRS, because in these cases, we're going to talk about in an enforcement section, there is an IRS campaign into folks who relocate to Puerto Rico. So what I've told folks is not whether you are going to be audited or examined or subject to an examination, it's when are you going to be subject to examination. And these processes usually take some time, so it might be a couple of years before you hear back from the IRS. And the best thing to have is a memo that has all your facts, all the exhibits, all the documentation necessary, ready to be delivered, so you are proactive about any efforts. Can we go to the next slide? So again, important tools that you can do now is gather your travel statements, build a folder, build a file. When you move to Puerto Rico, it is typical that your family will stay behind, maybe finishing the semester, maybe waiting for you to get the house ready, maybe waiting for you to get a car, maybe getting some roots established before you bring them over. And that is fine for a little bit. But as more time goes by, it becomes more problematic and more risky. So think about, does it make sense that it's been 3 years and your family still lives in your former home, you're still together, and you haven't broken that tie? Again, the financial statements, very important. Has your credit card being really used in Puerto Rico, or are you making top transactions somewhere else? Ideally, you would get a bank account in Puerto Rico and you would use a local bank. You would get a local driver's license registered to vote, surrender your former driver's license, work for a local business, not have a working employment relationship with a U.S. company or U.S. partnership, and then keep good records. Keep good records of everything. Let's see. Okay. We can move on to the next slide. So, phase one, let's call it baseball. First base, you do prove that you're a Puerto Rico bona fide resident. That by itself is just 1/3 of the way to get the benefits and be in a defensible position with the Internal Revenue Service. The second thing you would want to do is assess your financial situation. And the way I approach this with clients and prospective clients, so once we determine that you are a bona fide resident of Puerto Rico, let's evaluate your current structure. How are you going to be subject to tax in Puerto Rico and in the United States if you keep your structure as it is? And to do that, you really have to go down into the details and you have to break down each of the items of income and assets to determine their character. And what are the character? Character could be services, could be interest, could be dividends, could be personal property gain, royalties, and sales from inventory. And they all have special rules. And one of the common situations that many advisors tripped on initially when the rules became more popular and more people were relocating to Puerto Rico, under Internal Revenue Code, when a person sells personal property, the sale is deemed at the residence of the seller. And that is the rule if you move to Mexico, if you live in Argentina, if you live in Norway, if you go to Belgium, if you're in France, if you're in Australia. But that is not the case if you move to Puerto Rico and you were a U.S. resident or you are a U.S. citizen before the move. So for services, the general rule is where the services perform. If you're providing services from Puerto Rico, those services, the income generated for those services will not be generally subject to U.S. tax if you're a bona fide resident of Puerto Rico. And Jorge will work with you on establishing a structure that would maximize how they are taxed on the island. Interest. If you have an interest from, let's say, a bank in New York, it'll be interest sourced in the United States, subject to tax in the United States, which Jorge would make your tax return included as U.S. source income. However, if you have interest in a U.S. company, then a Puerto Rico company, it would be Puerto Rico-source. Dividends it's a really interesting one, and it's important because part of the typical structuring for Puerto Rico incentives involves dividends from an export services company to an individual investor resident of the island, which are generally eligible for tax incentives. But if you do receive a dividend from a U.S. corporation, that dividend will be typically U.S. source income. I'm going to leave personal property gain for last. Royalties, you generated this code. It's very helpful. It will tell us how to solve the math on the most complicated issues, and it'll solve many illnesses. It'll be sourced where the IP is used. It'll be sourced if it's yours in Puerto Rico for an export service company. It'll be Puerto Rico source. If you are licensing that IP to a company in Beverly Hills, it'll be California source income, U.S. source income, served to the United States. Inventory produced property, that'll be depend on special rules for inventory, depending on where it's manufactured, what goes into the work, it'd be 50-50. There are other special rules for that. But then going to personal property, which becomes one of the most important items of income when folks are evaluating a relocation to Puerto Rico. The typical question that I've gotten maybe a dozen times in the last 12 months, I am about to sell my business. I want to move to Puerto Rico very soon so I can take incentives on all the gain. It doesn't work like that. And it doesn't work like that because there's a special rule that applies, again, if you were a resident of the United States, which will tell you any pre-move gain will be resourced rather than Puerto Rico as a U.S. source gain. And then you can make an election depending on the asset to treat it as, if it's a marketable security, you could get a mark to market the gain and then identify the pre-move and the post-move. If it's not a marketable gain, there's an allocation that we'll touch base and discuss in a little bit, but we can move to the next slide. So when looking at the character and when looking at the items of income to determine whether this makes sense and whether it works, you need to determine who performed the services, where decisions were made. We have a number of fund stakeholders considering moving to that land, whether it's investors, whether it's fund managers. You need to determine where the decisions were made, and it could have different consequences. If the fund is a U.S. fund and the person is in Puerto Rico, you potentially cause the fund to be treated as having a trader business in Puerto Rico. One key point here, Puerto Rico does not have any tax treaties, so you wouldn't be establishing a permanent establishment. It would be a trader business, and it would follow similar principles than the principles used by the Internal Revenue Code in the United States. But similarly, you might want to be careful that you're not treating or creating a Puerto Rico fund as having a trader business in the States. A very, very important point, especially when you're looking at export services. If you are providing export services to a related party, an entity that you also own or that you have an affiliation with, are those payments priced at the same price that someone who's not related would price them? Are they arm's length? For that, you should and probably should very likely get a transfer pricing report, get a pricing study. Make sure that the terms are what some other people would pay for the same transaction. And then substance over form. The IRS will follow the substance. If you call something a license, a royalty, it has to be supported by the treatment that you're giving it. Again, red flags, it has to happen. It can't be paper only. You can't keep the same ties. One thing that I've seen on a number of occasions, you seek advice of a tax advisor, but the advice doesn't specifically address your facts or your situation, which becomes less valuable in the case of an examination from the IRS. And then it's good to be proactive and contemporaneous. It loses the value when things are done retroactively. Okay, next slide, please. So going to the baseline for we can go one more. Going to the rule for personal property, a 10-year look back rule. So if you're moving to Puerto Rico and you do have personal property, again, let's think about stock in a business that you're about to sell. If it's not marketable, it's not publicly listed, you don't have a market value for that, you could elect to treat the gain pro rata, Puerto Rico-source versus U.S. source, based on the proportionate base if you held it as a resident of Puerto Rico versus your entire holding period. If it's marketable, you can market the value as of the date you established residency in Puerto Rico, and that'll be relevant for your analysis. It is the rule. The IRS has actually issued a number of guidance after this has become an issue, and it's now very clear that this is the position of the government, despite some questions that might exist. And Philip, do you want to comment a little bit on how this comes into effect for crypto?
Yes, who knows me knows that I can talk about crypto forever, so I will keep it short. But if we are going to the 10-year look back period is one of the stepping stones always. But if we are going to the next slide, to the crypto slide, and the first start you're doing is you're starting with a character before you even start with sourcing. Crypto is property, and we know that on it since 2014. But that only begins the analysis. It doesn't, the 2014-21 notice, it says crypto is property, does not tell us what kind of property it is. So that only begins the analysis. The tax result depends on whether the item is a sale gain, ordinary gain, service income, mining income, staking rewards, you name it. So let's start with sales. It's the typical sale of properties that Jorge just explained. If the taxpayers sells Bitcoin, the first instinct is, of course, personal property gain under 865A, generally sourced by seller residents. But Puerto Rico cases require the overlay of 937 and especially Treasury Regulation 137-2. So you have to have the pre-move crypto, and that's one of the most common audit traps. So a taxpayer who held crypto before becoming a Puerto Rico resident cannot simply move and sell and treat the entire gain as Puerto Rico source. There's a 10-year look-back period. And now you have to determine whether crypto is a marketable security or other property. A few years ago, might have been more clear that it was other property. By now, especially with all the crypto ETFs, and the expansion of centralized exchanges, some of the crypto looks more and more like marketable securities. What is a marketable security? That means financial instruments and foreign currency, which are, as of the date of the distribution, actively traded. And even so, digital assets are not traded on any named, which is called an established financial market, under 1092. And you have the list of what is an established financial market on Treasury Regulation 1092D-1A. And this list does not mention centralized exchanges. But it's not conclusive. So now is the question, does a centralized exchange look like one of these financial markets that are described there? The other question is if decentralized exchanges are looking like these markets. At least centralized exchanges look more and more like these markets these days. So there is an argument, but you have to make a token by token determination these days, if you want to move for that. There is then the move date valuation that is not optional. You have the staking rewards that are not sale proceeds. We have revenue ruling 2023-14 and the recent Pashal case that basically treats staking rewards as income when the taxpayer has dominion and control. So for Puerto Rico purposes, that creates a separate timing character. It's especially a source issue. The question is, where was the service performed? Right now, there's no clear guidance from the IRS how to treat that for staking, where the service is performed. It could be the node, it could be the sellers, or the service provider's residence. You have to make that determination. And for these, especially for crypto, for these character and sourcing, document it. Document it when you determine it and put it in your audit file. You have mining, similar analyzed like active income. You have lending DeFi that require protocol level analysis. You have NFTs that may not be as simple as capital assets. So the IRS wants to, and one other point for your audit files, the IRS wants native data. So just having a Coinly report doesn't cut it. Just puts the native data, meaning the exchange, the CSV file from the exchange in your audit file for later audit. But Jorge Kilan, how does Puerto Rico treat it?
Okay, so Puerto Rico, in one of the last iterations of Act 60, added cryptocurrency as eligible asset, specifically under the definition of other assets in the law. So they are certainly eligible. But then, as you mentioned, Philip, what is subject to the 0% is the post-move appreciation. So that pre and post-move analysis needs to take place in order to make sure that we cover the U.S. tax liability on that pre-move appreciation. And also there may be a balance in Puerto Rico, subject to Puerto Rico tax if we cannot apply a full tax credit for U.S. tax paid on those pre-move appreciations. Then the staking, mining, and rewards income, we need to be careful on how we analyze each of the income streams, because not everyone is going to be eligible for the capital gain treatment. So Puerto Rico, under Act 60 for investors, is sheltering capital gains from the disposition of cryptocurrency, and again has made cryptocurrency eligible for the investor benefits, but not all income streams are eligible. And also we can see under the export services regime, if one of those different income types, given they are tax at ordinary rates, could be structured as a service instead of the capital gain regime or the ordinary regime that applies in the US. So once again, just same as it goes with the different types of investments, we need to make sure what could be eligible for capital gain treatment. And then Puerto Rico, also one critical distinction, and it goes along the lines of what Jorge has been discussing, is that in order to be able to claim the investor benefit, when you realize that capital gain, you need to have a degree in good standing, right? Because it does not apply to you automatically if you just move to Puerto Rico. Again, you need to go through an application process, a vetting process internally by the Office of Incentives, and also the different tax agencies that are available in Puerto Rico. So next slide, please.
Pivoting a little bit to another common fact pattern that we receive quite often, in particular from the West Coast, is funds. If you had a fund, stateside fund, investing in the US, stateside US, typically you would potentially have a number of limited partners who could potentially be investing through a entity of some sort, maybe their own LLC, maybe an investment vehicle. But in many cases, you will have a manager who will be acting as a general partner. And in many cases, these roles are under the standard structure carried on by an individual that could potentially be doing this as an LLC or that's disregarded or under their own name as an individual. This creates significant risk if the individual who is the fund manager relocates to Puerto Rico. And there are several complexities with this move. The first one is, for the fund, it could to the extent that the fund manager is making decisions from Puerto Rico, it could be deemed as if the fund were engaged in a trade or business in Puerto Rico, and the income generated by the fund could potentially be subject to tax on the island. And if the fund does not have a tax incentive decree, it could be a pretty high tax bill. Second, for the fund manager, it is not as simple as maintaining the current structure, because it would affect its bona fide residency analysis. The one thing that in some cases is doable is that the fund manager establishes a management company that provides fund management services to that fund. And then potentially you could work with Jorge to make sure that the services are eligible and there's a good transfer pricing report in place. And that fund manager provides services to the fund in something that's arm's length transaction, properly documented, and then the distributions of the export services to the individual are eligible for tax incentives. The risk becomes additional because some funds do not the risk could become the risk could increase when it is not clear whether the services performed by the manager are a gain on sale of the investment or it's for services. And in some cases, they rather not have services income because it could potentially be taxed in Puerto Rico under general ordinary tax rates. But it could potentially not work that it is truly a sale on an asset if it's appreciated before the move. So in the case of fund structures, partnership, carried interest in particular, there has to be a lot of work done. And this is actually one of the areas most litigated by the IRS, or in which the IRS has had some of the bigger victories. And in fact, it has issued guidance. There's a CCA and there's another memo addressing the treatment of sales by partnerships. And there's notes saying how it applies similarly to S corporations when one of the owners, shareholders, partners, or members is a resident of Puerto Rico. It says in effect that it doesn't matter that the partnership was a U.S. partnership or a U.S. S corp. The sale will be treated as if the U.S. individual residing in Puerto Rico has sold it, and it's subject to the same personal property sale rules, resourcing the gain from Puerto Rico to the United States. So again, lots of attention here. This is just a flag. I'm not sure, Philip, if you want to add anything on this point.
No, just if you see it in the news, it's caught a lot of attention recently.
Jorge, do you want to talk us through reporting?
Sure. So, international reporting overlays. This is a typical pitfall because when you think about Puerto Rico and you see that it's a U.S. territory, you don't actually think that investing in Puerto Rico from a federal standpoint can look as investing in any other foreign jurisdiction. And at the same time, Puerto Rico LLCs, which is a typical vehicle used, by default is taxed as a corporation for U.S. tax purposes. So, what we're trying to convey through this slide is that when you encounter Puerto Rico, don't treat it as purely domestic planning, right? There's almost always going to be an exception to the rule or a particular rule. And one example is this, that check the box regulations don't work the same way as they work in the US. If you want to, a Puerto Rico LLC to be considered disregarded or a partnership, depending on how many owners it has, you have to check the box for that Puerto Rico LLC. So with this, what we're trying to convey is that anytime a Puerto Rico entity is involved, proceed with caution and think of it from the lens of an international entity, not actually a domestic entity. So, for example, depending on the ownership, it could be deemed a controlled foreign corporation, especially when you have majority U.S. owners. It can trigger subpart F inclusions or guilty inclusions. Essentially, that Puerto Rico corporation is doing business in the U.S. on behalf, or the owner is doing business in the U.S. on behalf of the entity. That creates income effectively connected with a U.S. trade or business, and that can trigger the punitive tax regimes that would normally apply to international operations. Then, by the same reason, the forms, different forms, the 5471, the 8865, 8938, FBAR, and Form 8898, to mention some, should be checked because, again, it is required for entities, international entities doing business in the U.S. Also, the withholding provisions also need to be looked at carefully because those would apply to any foreign jurisdiction in terms of any payments made to owners of foreign entities. And lastly, the trading safe harbors. When it comes to crypto, the IRS current position is silent as to whether crypto falls under the trading safe harbor. So that's another area that when you set up crypto structures, and Philip can certainly vouch to this, you need to make sure whether you can take a position under the trading safe harbor, especially for potential Act 60 individual investors. So again, it's just a typical pitfall that when you see Puerto Rico and think of it as a U.S. possession, it is, in practice, it doesn't behave that way. It behaves more as an international jurisdiction. So proceed with caution there.
I think we're running out of time, so I'll say from an enforcement perspective, there is a lot of enforcement. There is an active IRS audit campaign looking into individuals who have relocated to Puerto Rico. And it is very important to be proactive about seeking good, competent advice. And it really takes a team. It takes a U.S. advisor. It takes a good CPA. It takes a good Puerto Rico counsel as well. And the sooner you start with the planning and you get on the documentation, the safer you will be. Again, it's not if you're going to be audited, it's when. Philip, I'll turn it to you.
Yep, and I can just second that. Choose wisely your local advisor. You're really depending on them for a lot of things, not only communicating with the hacienda, but also timely filing, understanding the different rules. So one other aspect, if you're new to that, you might want to look, there's FOIA materials. I'm not sure if I hope I have put that down there in this. If not, reach out to me. I can send you the link for the FOIA materials. But it's basically hundreds and hundreds of pages of IRS training materials. The GAO report from last year, very helpful to understand, especially that the IRS focused on the 2021 tax year and now was pressured or forced to also data match the other years that Hacienda provided. So there will be an influx in newer cases, certainly. And there is a DOJ that is focused on these cases. There's Senator Biden, who has an eye on these Puerto Rico cases. There's the IRS campaign for Puerto Rico. There's also an IRS LBNI campaign for crypto. So that's a double risk. And one thing I can't focus enough on is the Form 8898 for all advisors out there. Be aware, people who move to Puerto Rico have to fill that form. And if I'm correct, also, if you're moving back, you have to fill that form. Don't forget it in the first and last year. And Jack, I'm sorry that we couldn't comment on your planning your virtual law firm in Puerto Rico already. But if you send us your email address, we will get to your questions. So, and with that, I will close. Thank you to everyone. Thank you to Jorge and Jorge. And reach out to them if you have any questions. Yep. Thank you so much.